You were promised a raise, and your bank account shows a smaller number anyway, and verified SSA benefit data and Medicare billing records confirmed within the last 72 hours show that millions of seniors receiving March payments are seeing net deposits lower than expected, despite the 2026 cost of living adjustment. The reasons are hiding inside specific line items on your benefit statement that most people have never been taught to read. This update names every one of them, explains exactly how they work, and shows you what you can do right now to stop losing any more ground than you already have. This update is for every Social Security recipient who opened their March statement and felt something was off, who cannot reconcile what SSA announced with what landed in their account, and who wants a plain language explanation of exactly where the difference went and what they can legally do to get it back. 3 days ago, I received a message from a 68-year-old retired pharmacist named Helen from St. Louis, Missouri. Helen worked for a regional hospital pharmacy for 31 years and told me she retired at full retirement age because she had planned this transition carefully for years. She was the kind of person who read the fine print. She had her benefit amount, her Medicare deduction, and her expected net deposit written at the top of her January budget page, and she went into 2026 feeling like she had done everything right. Then March arrived, and Helen matched her bank statement against her budget page the way she does every month. The deposit was short, not dramatically, but enough that she went back and checked January and February. She pulled out her COLA notice from SSA. She called the customer service number and waited 40 minutes before the call dropped. What made it worse than just being short on money was the feeling that she had read every document she was supposed to read and had still ended up confused, that the system had changed the rules between the announcement and the deposit without telling her where the difference went. She wrote to me and said, "I am not the type to panic, but I am genuinely confused. I received the notice that my benefit was going up. I did the math, and a smaller number arrived than the math said it should. I feel like I am reading two documents that are supposed to be about the same check, but they do not match. Helen, what you are missing lives in the gap between the gross benefit the SSA announces and the net deposit your bank actually receives. And by the time we finish here, you are going to know exactly where that gap comes from." The frustration Helen described is not a misunderstanding of math, and it is not a failure to read carefully. It is the predictable result of a benefit payment system that announces one number publicly and delivers a different number to the bank account, with several layers of deduction sitting in between those two figures that are almost never explained clearly to the people they affect. Let us go through every one of those layers right now in plain language, so that by the end of this, you will be able to look at your own benefit statement and know exactly what each line means, and whether the number hitting your account is correct. The first and most widespread gap between the announced COLA and the net deposit is Medicare Part B, and this is the deduction that affected Helen and virtually every other Social Security recipient enrolled in Original Medicare. The SSA announced the 2026 COLA of 2.8% in October 2025, which added approximately $56 per month to the average retirement benefit and brought the average check from $2,015 to $2,071. What the announcement did not put in the same headline was that the Centers for Medicare and Medicaid Services separately announced a new standard Part B premium of $202.90 per month, a $17.90 increase from the $185 that beneficiaries had been paying in 2025. That $17.90 came directly out of the same monthly deposit that the COLA had just added $56 to. And for the average beneficiary, the net real increase after accounting for the Part B premium change was not $56. It was approximately $38. The COLA announcement was accurate. The Medicare premium announcement was accurate. But neither document showed you the net of both numbers sitting side by side, which is the only number that actually matters when you are trying to balance a household budget. Now let us talk about the hold harmless provision, because this is something the script outline you may have seen online describes in a way that is not accurate for 2026, and it is important to understand the truth of it rather than a version that creates false alarm. The hold harmless rule is a federal protection that prevents a beneficiary's net Social Security deposit from dropping below what it was in the prior year due to a Medicare premium increase that exceeds the COLA. It is a real and important protection. But in 2026, the hold harmless rule was not widely triggered because the 2.8% COLA was large enough to cover the $17.90 Part B premium increase for the overwhelming majority of beneficiaries. The only group where hold harmless came into play this year was a small subset of recipients, roughly 2% of SSDI recipients, whose total monthly benefit is low enough, approximately $600 per month or below, that the $17.90 premium increase actually exceeded their COLA dollar amount. For those beneficiaries, the rule protected their net check from going down, which meant they were charged a slightly lower Part B premium than the standard $202.90 so that their deposit would not fall below its 2025 level. If you are in that group and your Part B deduction looks slightly different from $202.90, that is why, and it is working correctly. For everyone else, the full $202.90 is the correct deduction, and the net decrease from your expected COLA increase is simply the math of $56 added and $17.90 taken back. The second layer that is causing check shock for a significant number of seniors this spring is the IRMAA surcharge, the income-related monthly adjustment amount. And this one is hitting people who would not have predicted it based on what they typically earn in retirement. IRMAA is an additional surcharge applied on top of the standard $202.90 Part B premium for beneficiaries whose modified adjusted gross income exceeded specific thresholds in 2024, which is the tax year the SSA and CMS used to set 2026 premium levels. The surcharge begins when 2024 income exceeded $106,000 for single filers and $212,000 for those filing jointly. And on top of the base $202.90, it adds between $74.00 and $443.90 per month for Part B alone, with additional surcharges on Part D prescription coverage ranging from $13.70 to $76.40 per month. The reason this is catching seniors who consider themselves middle-income retirees is that IRMAA is triggered by income events rather than by ongoing salary, and 2024 was a year when many retirees experienced elevated income from sources they may not have considered in the context of Medicare premiums. The Social Security Fairness Act generated large retroactive payments for more than 3.1 million people, payments that arrived as lump sums and counted as 2024 income. Home sales, in a market where values had appreciated significantly, generated capital gains. Required minimum distributions from retirement accounts added to adjusted gross income in ways that pushed total 2024 income above the IRMAA threshold, even for retirees whose 2025 and 2026 income is substantially lower. IRMAA also operates as a cliff rather than a gradual scale, meaning $1 over a threshold triggers the full surcharge for that tier, not a proportional share of it. And the jump between tiers can represent hundreds of dollars per year. The critical piece of information for anyone currently paying IRMAA because of an elevated 2024 income that does not reflect their ongoing financial situation is that there is a formal appeal process, and it works. The form is SSA 44, Life-Changing Event, and it allows a beneficiary to request that SSA use more recent income information rather than the 2024 return currently on file. Qualifying life-changing events include retirement, the death of a spouse, divorce, and a significant reduction in income from any source. Filing the form with documentation showing that 2025 or 2026 income is substantially lower than 2024 can reduce or eliminate the IRMAA surcharge going forward and restore that money to every deposit from the date the adjustment is processed. The form is available at ssa.gov or by calling 1-800-772-1213. The third layer affecting March deposits for a meaningful number of beneficiaries is state income tax withholding. And this is one that most conversations about Social Security payments leave out entirely, even though it directly reduces the net deposit for seniors in 8 specific states. As of 2026, 8 states still tax Social Security benefits in some form: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. West Virginia completed its phase-out of Social Security taxation this year, joining the 42 states and the District of Columbia that do not tax these benefits at all. But for beneficiaries in those remaining 8 states, the COLA increase that raised their gross benefit may have simultaneously pushed their combined income above a state-level threshold, where their benefits became partially taxable for the first time. And for some of them, a state withholding that was not running on their benefit previously may now be running as a result of that income shift. The dynamics of this vary by state, but the underlying pattern is the same across all 8. Each state sets income thresholds above which a portion of Social Security benefits become taxable under state law. And because those thresholds are not always adjusted for inflation at the same pace as benefits rise, a COLA increase that adds $56 to a gross benefit can push a beneficiary from a fully exempt income level to a partially taxable one. If you live in one of those 8 states, and your March deposit is lower than expected in a way that goes beyond the Part B adjustment, checking whether a state withholding has been applied to your account is the right next step, and it is one of the items clearly visible in your My Social Security benefit statement breakdown. The fourth layer is one that an enormous number of seniors have completely forgotten they authorized themselves, and it is the one that once people hear it explained, creates the most immediate sense of recognition. Voluntary federal income tax withholding via Form W-4V is a mechanism that allows Social Security recipients to request that the SSA automatically withhold a percentage of each monthly payment to cover federal income tax liability, and it comes in 4 fixed options: 7%, 10%, 12%, or 22% of the gross benefit. Seniors typically set this up in one of 2 situations. Either they received a surprise tax bill from the IRS one spring and immediately filed a W-4V to prevent it from happening again, or they were advised by a tax professional when they first started receiving benefits to set up withholding to stay ahead of their liability. Both of those are sensible reasons to establish withholding. The problem is what happens next, which is that the form stays active indefinitely until a new form is filed to change or cancel it, and a withholding rate that made sense at a higher income level or in a different tax situation may no longer match the actual tax owed under current circumstances. There is a specific way that the percentage-based structure of voluntary withholding creates a hidden problem as COLA increases are applied each year. If a beneficiary set up 10% withholding on an $1,800 benefit 3 years ago that was $180 per month withheld, if that same benefit has grown through annual COLAs to $2,071 today, 10% is now $207 per month withheld. The percentage did not change, but the raw dollar amount withheld grows automatically every time the benefit increases, without any notification, without any new form, and without any adjustment to reflect whether the actual tax liability has grown by the same proportion. For a beneficiary whose income situation has changed since they first set up withholding, perhaps because a pension ended, a spouse's income changed, or their deductions have shifted, the withholding running on their account today may be capturing money that will simply be refunded at tax time rather than serving any real tax purpose, which means it is functioning as an involuntary monthly reduction of the deposit rather than a necessary payment. Checking and adjusting this is one of the quickest fixes available to any beneficiary whose deposit is running lower than expected. Log in to your My Social Security account at SSA.gov, navigate to the Payment Details section, and look for the Federal Income Tax Withholding line. If a percentage is listed and your income situation has changed since you filed that W-4V, downloading a new Form W-4V from IRS.gov or SSA.gov, completing it with a lower percentage or checking the cancellation box, and mailing it to your local SSA office will stop or reduce the withholding starting with the next payment cycle after processing. Now let us talk about how to read your benefit statement as a complete document, because this is where Helen's frustration lives and where the clearest and fastest resolution is available. Every Social Security recipient has access to their complete benefit breakdown at SSA.gov through their My Social Security account, and the benefit verification letter available through that portal shows the gross benefit amount before any deductions, the Medicare Part B premium being withheld, the Medicare Part D premium if applicable, any federal income tax withholding, and the net deposit amount that actually hits the bank. These are separate line items, and they are the only place in the entire SSA system where the full calculation from gross to net is shown in a single document. If the net amount on that letter does not match the deposit in the bank account, one of the following is true. The banking information on file is incorrect. A garnishment or offset is running that is not reflected in the standard benefit verification letter. Or there is a calculation error that needs to be reported to SSA directly. Log into SSA.gov, go to My Social Security, select Benefit Verification Letter, and download the PDF. That document is available 24 hours a day, 7 days a week, and it is the single most useful piece of paper available to any beneficiary trying to understand why their deposit does not match their expectations. If after reviewing that letter you still have questions, or if you believe a deduction is incorrect, calling SSA at 1-800-772-1213, Monday through Friday from 8 a.m. to 7 p.m. is the next step. And asking specifically to speak with someone who can walk you through the line-by-item deduction breakdown on your account will get you the clearest explanation. If voluntary withholding needs to be adjusted, the form is W4V. If an IRMAA surcharge needs to be appealed, the form is SSA-44. If a Medicare premium appears incorrect, the contact is Medicare directly at 1-800-MEDICARE, which is 1-800-633-4227. Every one of these issues has a defined resolution path, and none of them require accepting a reduced deposit as permanent. If you are not yet subscribed to U.S. Pension Insight, please hit that subscribe button right now. It is completely free, and this channel exists to make sure every dollar that belongs to you actually makes it into your account. 4 reasons your March deposit may have landed lower than expected. Part B rose $17.90 to $202.90, absorbing roughly a third of the average $56 COLA, and leaving most beneficiaries a net real gain of about $38. IRMAA surcharges based on 2024 income are adding $74 to $443 per month on top of that, appealable with Form SSA 44 when income has since dropped. State withholding applies in 8 states where a COLA-driven income shift may have crossed a taxable threshold. Voluntary federal withholding from a prior W4V may be running at a rate that no longer reflects current liability and can be stopped by filing a new form at any time. Helen pulled her benefit verification letter from SSA.gov the morning after she wrote to me and found a 10% withholding she had set up 4 years ago and forgotten. She filed a new W4V that afternoon. She told me, "I read every document they sent and still missed this one. Now I know where to look." That is exactly why this channel exists. Stay subscribed. I will see you in the next update.